We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bill Holter. He's a precious metals broker and partnered with Jim Sinclair over at JSMineset.com. How are you today, Bill?
Good, Tom. Thanks for having me.
Great to have you back. So what was your experience like with the recent storm in Texas? We know that, the power outages and stuff came through. So what were some of the lessons that you learned from that experience?
Quite a few. One, don't always believe the immediate weather forecast because what was forecast ahead of time was not what happened. We were supposed to get a couple days of freeze, couple days of thaw, couple days of freeze, and that was it. And it turned out to be, we went 8.5, almost 9 days, under 32, 3 days where I don't think it got over 21 or 22 degrees. And these numbers I'm talking to you about are numbers that you might see one night, maybe every 5 years. And this was like 8 days in a row. Texas, the building code, it's not built to withstand that type of temperature. We did not lose power. We have alternative power sources. We did lose water. Water is the most important commodity for life. You have to have water. And I've got 2 separate well pumps, and we have a pond, and actually it's a little more than a 1 acre pond, and it froze over. If I had to, I could have, taken like a half-inch ice. I could have busted the ice and hauled water up, not to drink, but we have purification systems. But we went 8 days with no water. We filled up, when we realized that we weren't going to have water, we filled up tubs and pots and pans, and we had enough drinking water. And I've got, a supply of drinking water, but it was a major inconvenience. And I guess what I'm getting at is this is something that when you're making your plan and you try to foresee whatever the potential boogeymen are, this was one that who could have forecast that the state of Texas, the entire state of Texas, was going to be below 32 degrees for 8 days plus straight. That's just not something that's, you don't even look at that as a tail risk. That was, in my mind, an impossibility, but it happened.
Mm-hmm. So, Bill, what kind of parallels could we draw from your experience there to the financial system going down? Obviously, the last time you and I spoke, you were talking about preparing for a storm that Mother Nature could throw at you, and now you've had that. So what are some of the parallels that you can draw to the next coming storm?
Well, I'm not a mathematician, but I would say the event that we just went through, as far as weather is concerned, I don't know, is it a 5 sigma, 10 sigma, 25 sigma event? I don't know, but it was the worst storm to ever come through here, and the closest one to it was 150 years ago. From a financial standpoint, the storm that's coming is, in my eyes, 100% obvious. It's 100%, call it mathematics. There's $280 plus trillion of debt outstanding. There's over 1 quadrillion worth of derivatives outstanding, and neither the debt nor the derivatives are going to perform. They're contracts. The question is, what is a contract valued at that cannot perform? And the answer is 0. And that's what you have in the credit markets, and that's what you have in the derivatives markets. The tail to this dog is 10 times larger than the dog itself.
Mm-hmm. Bill, what is the total debt to GDP ratio right now? And is there a point at which this ratio becomes critical for the health of governments or currencies?
Well, globally, I think the debt to GDP is something like 325, 350%. And if you go back to, I graduated college in 1982, and if you remember, that's when the Mexican/South American crisis was coming and going, and any country that got to 100% of debt to GDP was considered becoming a banana republic. Mm-hmm. And here we are as a total globe, 3.5 times that. And the end takeaway is that the entire world is a banana republic, both financially and from a judicial standpoint.
Mm-hmm. So the Buffett indicator being at an all-time high, is that just another cause for concern, or does that kind of get lost in the fray here?
No, it's absolutely a cause for concern. I mean, what you're doing is you're looking at total capitalization of the stock market or stock markets versus what the real economy actually produces. And what people have forgotten is that you have to have a vibrant real economy to service debt. And what happened with COVID, and I'm going to say that the timing of COVID was very fortuitous. COVID came along in February, March of last year, and that was right after the September, I think it was September 16th or 17th, where the repo market blew up. Mm-hmm. The Federal Reserve was pumping in $50 to $100 billion every single night just to keep repo under control. And I guess from the standpoint of what is the best pressure relief valve to the credit markets, well, it's a weaker economy. So shutting down countries left and right eased the pressure on the credit markets. And it allowed the Fed, it allowed the ECB, the Bank of Japan, Bank of England, it allowed all these central banks to go crazy printing money under the cover of, we're doing it to save the people. When in fact, they were going to have to do that anyway, but now they had a reason to point at, that they were forced to do it.
Mm-hmm. So have any of these risks of that repo market, have they gotten any better, or is it just, a matter of time before something like that happens again if we get some monetary velocity come back into the system?
If the real economies come back the way the forecasts are saying, and I personally doubt that they're correct, but if these forecasts are correct, then you're going to have upward pressure on demand for credit. And of course, the price of credit is the interest rate. And you're actually seeing that now. You're seeing interest rates being pressured higher. Mm-hmm. And the danger is we live in a world that is more overlevered than any point in the history of history. And interest rates really cannot go higher. If they go higher, they blow the debt bubble. And you've seen that every time. You saw it in 1987. You saw it in 2000. You saw it in 2007. You saw taper tantrums throughout the 2000 teens. Interest rates cannot go higher and stay higher because they will destroy the real economy. You'll see the real economy go, and then you'll see the financial sector go because the debt that's within the real economy can't be serviced.
So, Bill, how far do you think we are from seeing some type of yield curve control?
We could be a day away. I mean, they're going to have to do something. They rig all markets, and that's one market they cannot let on its own. It has to be rigged. They have to prevent interest rates from going up. And I'm sure your audience understands that they have to prevent silver and gold from going higher because that is a sign of loss of control, and then they would lose control of the credit markets.
Mm-hmm. So, Bill, do you see this as one of the biggest risks for the financial system right now, or are there any others that you think that people need to pay attention to as well?
Well, there's all kinds of risks out there. The biggest risk is that the amount of credit that's been created has created an everything bubble. Everything, all financial assets are in the biggest bubble in the history of mankind. And I mean, back when history books actually had real stuff in them, before they were sanitized by wokeness, you read about the Mississippi bubble, the South Sea bubble, the tulip craze, go on down the list. And you could roll all of those up into one and still not get to where we are living right now.
Mm-hmm. So with the advent of COVID, we saw lots of moratoriums for rent and extended credit. Do you think that this new stimulus package is going to help ease this, or are we going to see, more foreclosures and eviction, stuff like that, start to take place here?
Well, you tell me. There's 11 million homeowners right now that are behind on their mortgage. Mm-hmm. Are $1,200 or $2,000 or whatever the amount of checks, is that going to bring people current for the last year that they haven't paid?
Definitely doesn't seem like it.
No, I mean, the answer is no. Mm-hmm. And what happens when the moratorium's lifted, mm-hmm. and people are allowed to be foreclosed on and people are allowed to be evicted? They're going to be evicted. Mm-hmm. And remember, for every asset, credit, debt, it has two sides to it. Mm-hmm. For every liability, that is someone else's asset that they rely on for income or what have you. And another thing to look at is that with interest rates rising, the bond portfolios of these banks and even the central banks have shrunk, and credit, and I guess the primary credit is U.S. Treasuries, that is considered and used as collateral on bank balance sheets. And that is now becoming impaired from two different angles. One, the cash flow angle, and two, just the pure interest rates going higher discounts the bonds. So you've got pressure on financial institutions all over the world with interest rates going higher.
Mm-hmm. So as we talk about this, Bill, you say that we're going to see a deflation of assets and an inflation of goods. So can you explain more to us about this and let us know the causes of it?
Well, think about it. I just mentioned 11 million homeowners are behind on their mortgages. Once the moratorium on foreclosures and evictions ends, that's 11 million houses or pieces of property that are going to hit the market. I mean, how is that going to be supported? And you'll have people backing away. On the other side of it, all fiat currencies on the planet are credit-based. So when credit either weakens or actually seizes up, what's that going to do to the value of the currencies? The currencies will, and have been already diluted, they will decline in value. And there's your definition of inflation. When your currency purchases less coffee or less beef or less lumber or whatever.
So as we're talking about inflation, Bill, does it make sense to get, let's say, a fixed rate loan to buy a house and repay it with currency that's worth less?
In theory, that's what you do.
Mm-hmm.
The question is, if you go back to Weimar Germany, what did they do? They rewrote all the mortgage loans and rewrote them in terms of gold. So what they did was they did not allow the banks to take the losses. Mm-hmm. And they made the borrowers pay more than what they were required to under the original contract.
Interesting. So you've said before that if you know what the ending is, then you should be saving for it. So how do you go about this, Bill?
You save in silver and gold. I mean, if you look at the financial system, it's held up, as I just mentioned, by debt. Debt is the collateral for everything. So once debt unwinds, loses value, or actually seizes up and credit is no longer available, what asset do you know of that has no liability attached to it? The only two that I know of are both silver and gold. Some people would say, oh, well, you could buy farmland. Well, guess what? There's a lot of farms that were bought originally or remortgaged or whatever that have debt against them. But gold and silver, the way I see it, not only don't have debt use to purchase them, there's actually debt being used to suppress the prices on the short side. So it's almost like, a double bang for your buck.
Mm-hmm. So is silver still the most undervalued asset on Earth, even at these levels right now, in your opinion, Bill?
Yeah, it is. We've gotten down to about a 65, 68 in that range, silver to gold ratio. Mm-hmm. And it comes out of the ground at 10-1, which is God's ratio. And I can understand it being discounted somewhat. The reason silver was originally discounted hundreds of years ago from the 10-1 ratio was because you had to carry 10 times as much on your mule or your horse or whatever. So there's a natural discount, and man discounted it to about 15, 16-1, even though it came out of the ground at 10-1, just because of the manpower, horsepower, whatever you needed to haul 10 ounces of silver versus 1 ounce of gold. So at 65, yeah, I wouldn't really look to start moving silver assets into gold until you definitely saw under 50 and maybe even under 40 for the ratio.
Right. So I was recently reading, Bill, that 85% of the silver in London is already held by ETFs. So does this mean to you that there could be a shortage?
Were you surprised when you heard that?
Personally, no.
Okay. Yeah, to answer your question, if 85% of the silver in what ostensibly is the largest silver vault in the world, if that's already spoken for, I mean, it's pretty obvious that we're moving into shortage. Mm-hmm. We've been in shortage. If you look at the yearly use versus the yearly production, and production, I think on silver peaked in 2016 or 17. So the supply has declined. Demand is going to naturally go up just because there's more money out there. So we've been in a deficit situation, and I think we're entering the shortage situation.
Mm-hmm. More demand, more money, and more industrial uses, right?
Right, and less supply.
Mm-hmm. So what considerations do you think that people missed when analyzing the silver market? And do you think that there has been any meaningful progress made in silver finding its true price discovery?
I think from the standpoint of knowledge, I think there's more people out there now than there were a year ago or 5 years ago that are beginning to look at both silver and gold as the safe haven that they've always been.
So what do you think the chances are of this silver squeeze movement really producing this, real price discovery of silver, forcing these shorts to cover? What do you think the likelihood of that happening is?
I have no idea as far as the Reddit movement is concerned, whether, that's going to actually do it or not. But I have absolutely zero doubt whatsoever that silver and gold are going to find their true values, and you are going to see a rocket ship out of silver to get there once the average person it's plain to see that there's not enough silver at current prices. Now, if you had $1,000 silver, there'd be plenty of silver because you'd have people selling it. But at these prices, they're not selling silver. You don't have, go back to 1980 when the Hunt brothers ran it to $50 an ounce. You had people going to their local pawn dealers with silverware, with old silver, with china. You're not seeing that now. That's already gone and been done.
Right.
So at current prices, there's no doubt you're going to see a serious shortage.
So will the mainstream waking up to inflation that is already happening in the commodity space be the spur for gold and silver to start to move higher again instead of being, treated as this shiny pet rock?
I'm not so sure that the connection will be immediately made regarding inflation. I think it's more likely that you'll see financial events occur where, markets are imploding and people are jumping ship, frantically looking for a lifeboat.
Right. Bill, as we wrap up, do you think there's any considerations that people need to be taking right now that you think certain people are maybe missing, or anything you'd like to bring up?
Yeah, I've said for quite a few years now, maybe even as much as 6, 7, 8 years, I've suggested that people come home from work or stay home, if they're working at home, whatever, on a Friday, and turn off your water, turn off your electricity. And that will show you where the holes are in your plan, because once credit breaks, distribution is going to break down. And when I'm saying distribution, I'm talking about going to your grocery store and it's either seriously understocked or even closed. So I think it would be a good learning experience to go 48 hours with no water, with no food, where you could just go to the store and get it and have to live and survive with what you have. Because once credit breaks, and credit is mathematically going to break, once it breaks, you're going to have what you have, and that's all you have. For a spell. Is it 2 weeks or 2 months or 6 months or a year? I have no idea how long it will take for credit to come back and start, beginning to trickle and then flow. I don't know how long it's going to take, but I do know when credit breaks, it's going to be an extremely ugly, and it's going to be a process that's very messy.
Right. Yeah, it makes you really think that an ounce of prevention is worth a pound of cure, right?
Yeah, and people don't understand that absolutely everything that they do all day long, everything they use, flip a light switch. You just used credit because, these big power companies have to rely on credit. You eat a piece of bread. That loaf of bread did not magically get created by elves in the back room. There was probably 7, 10, 12 different uses of credit to get that one loaf of bread to the store. So pretty much everything that you do, you pump gas, anything and everything that you touch, credit has already touched. And if credit's not functioning, then those products aren't going to be created.
Absolutely, Bill. Let our listeners know where we can find more of your writing and more from you.
You can go to www.JSMineset.com.
Excellent, Bill. We really appreciate your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.